Good morning. Thank you for having me on the show. No, we are not destined to be always at a disadvantage, but at the moment, manufacturing in Europe is made less competitive by high energy prices. And yes, these prices are much lower than they were at the peak a few months ago, but the markets are still expecting an uptick in the prices this winter. And especially if you look at emerging Europe, those countries are very heavily reliant on manufacturing, more reliant than other countries at similar levels of income. So these elevated gas prices are going to make them less competitive, and it is a challenge.
I'm going to pick up what you said and I'm going to gently bat the ball back to you and say, well, when though, Beata, when are we going to find ourselves on a comparable level in terms of our energy costs? Because, of course, the US is blessed with its shale revolution and its a huge amount of on and offshore energy, whereas Europe, let's be honest about it, we don't actually like building new facilities on and around the continent as well. And we do have this big differential at the moment. So when can we find some competitive pricing?
Well, we were very surprised this winter, right? Not only because the weather was milder, but also we were very surprised by how well manufacturing was able to adjust. In particular, I have here in mind German industry. So I actually would be cautiously optimistic. The storage tanks are filled to a much higher extent than they were a year ago. So in the short term, we probably will not have shortages of gas. In the medium term, we are speeding up green transition. So yes, it's going to take, a few years before prices come down in Europe. But, after all, what matters is the trend, not just the current level.
I looked at the headline and then I looked for the massive downgrade and there wasn't one, was there? It's 2.3 to 2.2. The indication then perhaps is that actually growth momentum is still relatively intact for the region. But let me ask you, what is the specific risk from electoral outcomes in Turkey when we look at growth derived from engagement with that economy?
Well, so let me unpack our projections for you. So on the one hand, we have Central Europe, so the new EU member states, where the outlook for this year is somewhat bleak. Inflation is eroding the purchasing power of consumers. I mentioned already energy prices, and weak performance of Germany translates into lower export demand. On the other hand, Central Asia is doing better. I'm speaking to you from our annual meetings in Samarkand, and on average, this region is looking at a 5% growth rate. It has benefited, of course, from exports of commodities. It has benefited from inflows of capital and labor from Russia. Many IT companies have moved here. And in Kazakhstan alone, there are 15,000 companies with Russian capital that are operating. Also, remittances from Central Asian workers who are working in Russia are flowing. They are quite strong. And finally, the region has engaged in intermediation of trade between Western Europe and Russia. So this region is doing well. Now, Turkey. Turkey has, in recent years, prioritized growth over macroeconomic stability. And, there is a limit to how long you can pretend that the basic laws of economics do not apply. So there will be some hard choices that the government in Turkey will have to make, regardless of who is in this government.